Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. One of the hottest topics in 2025 was the growth and popularity of ETFs. Active ETF issuances exploded in growth, so did exotic ETFs and very unique ones. But the hottest topic was ETFs as a share class. The topic has continued in the 2026, and I have on the perfect guest to talk all things ETF share classes and what it means for financial advisors and the clients. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and bring on the star of the show. I'd like to give a very warm welcome to Kip Meadows. Kip is a founder and CEO at Nottingham Shareholder Services. Kip, thank you so much for coming on the show. It's an honor to have you on. Really excited about this conversation. It's going to be a good one. A lot of insight you can share to help financial advisors and their clients through very interesting time in ETFs and asset management. Can you please help tell us a little bit more about yourself and Nottingham Shareholder Services?
Sure. So Nottingham Shareholder Services is the transfer agent for our fund administration firm. Nottingham is kind of the encompassing for that. We've been helping investment advisors set up their own pooled investment vehicles since the late 80s, a long time ago. And we started out doing open-end mutual funds and got into what most people call hedge funds in the middle 90s. Have done some government accounts, foundations, endowments, and ETFs for the
Mhm.
last 7 or 8 years has really been 90% of the income and inquiries we get. It's really kind of taken over the investment market. But we handle the registration for all those types of funds and then the ongoing calculation of the net asset value, the for ETFs, the PCF delivery, and I'm dealing with the baskets and really all things operational.
Yeah, fantastic. Do you feel I started by talking about just a number of active ETFs last year that were issued, and they're very complex. Do you read some and you're like, oh my gosh, what is this? What is this product? How is a financial advisor supposed to explain this to their clients?
That's a really sage comment, I think, because yes, I absolutely do. It started out the simple index in ETFs. That was really the biggest market driver until 2020, 2021, when active ETFs became more commonly accepted and the SEC codified how they could be done. And then, as you know, a lot of the active strategies get filled in. It seems like there's always somebody out there that comes up with something that's new and unique and exotic and more exotic and leveraged and 3 times leverage and oh yeah and I think you made a really good point just then. If you go too far, how is the wealth manager, the portfolio, if somebody's helping with an asset allocation, how are you going to explain it to across the kitchen table from your client? If it gets too complicated, people just say, I'm not going to mess with it.
Yeah. Yeah, you're exactly right. And I think I'm a firm believer in, expand the toolkit for financial advisors so they can create better portfolios for their clients. But, you better make sure that alignment and you understand those products. And I'll look at someone as like, yeah, I can't answer. I don't know what they are. I don't know what they're doing.
That's the
Um,
principle of diminishing return, isn't it? When you get so far that you
yeah,
is that innovation really necessary? But yeah,
Yeah, exactly. So it's interesting. You also, when we had our previous talk, real quick before we get started, Kip, you are a Duke alumni.
that's right. So you and I
And
talked basketball for a few minutes. Yeah.
yes, I told you growing up, I was a huge Duke fan. And then that love for Duke changed awfully quickly when they beat Wisconsin beat Wisconsin, and I often talk in the championship game. Before that, I was like, "Oh, all those fans, they're just jealous when they complain that Duke gets all the calls. They're just jealous that Duke is really good and they get all the calls. It's not true." Then my eyes got opened up during that game, Kip.
That that was quite a game. Wisconsin was firmly in control into the second half, and if it wasn't for kind of an unworldly performance by Grayson Allen, they might have been national champions that night.
Yeah, it was great. We'll move along,
What
but
ifs? You know,
lastly,
there's
with
all
Grace,
sorts of what ifs in sports history, which is kind of fun.
there
Yeah,
really
that was a
is
great game,
funny.
and
It was. It was a great game. One of the better ones in recent memory. I will say Grayson Allen was recently he played for the Bucks a few years ago, and the home teams the home fans booed him. It's still like even though they played for the he played for the home team, they booed him for the first. It was fun, but because he literally beat the Badgers. Yeah.
one thing you don't want
So
to do is wear a Christian Laettner jersey in Kentucky 30,
oh yeah.
35 years later.
I can imagine. I can imagine. Some people just can't
Oh
get
no,
over it.
I understand. I still don't like Joe Namath and the Jets for the 1969 Super Bowl. So
Yeah. Exactly, exactly. Yep, we'll have to have you on another time and we'll talk
that'll be
sports.
fun. That would
We'll
be a
talk
lot of
sports.
fun.
There we
Yeah.
go. So back to ETFs. You kind of started, mentioning it a little bit, but like you said, ETFs for years, it was your vanilla index based ETFs. Now they've really changed. One of the biggest stories, like I said, was the ETF share class. Can you please provide us a little history lesson here on how we got to this point where ETF share classes and they are, taking the lunch of mutual funds?
Yeah. So you're right. They started out, index funds made a lot of sense, and then it was an efficient way for to deliver exposure to an index that the spider, those are huge ETFs now. But to give the wealth managers a way to give their clients access to the various indices, S&P 500, sector indices, and so forth. And then active ETFs, it was not accepted quickly. In 2020, the SEC made it easier to set up active ETFs, but the portfolio managers, the sponsors of the funds, really didn't. It was, if you look at back at the filings, it was a very slow growth, and then it's become exponential in the last two years, really. There are certain tax advantages to ETFs that are kind of compelling for a taxable shareholder, because of the way you can um, sell securities out of a portfolio in an ETF, and you defer the capital gain. You don't avoid it, but you can defer it if if the portfolio is properly managed. One of the worst things for a portfolio manager is you incur a capital gain because you've had a good investment decision. You've made it, and the portfolio has gone up. But two things can happen at the end of the year. Either your shareholder, your client, wants to liquidate part of the fund to pay the tax on that capital gain, and those assets then go out of the fund, or if they reinvest their dividends, which a lot of shareholders do, and it's probably a very good wealth management technique for the wealth advisors to suggest to their clients, then they're paying tax on money they didn't receive. You've got a capital gain, 1099 comes at the end of the year. You have to pay tax on it. And where's the cash for it? It's coming out of your bank account. Yeah, coming out of income. So that is why ETFs, that's one of the biggest reasons ETFs have been popular. That and probably the younger generation, whichever letter it is now, Z or X or whatever it is. Yeah, they're walking around looking at their phones all day, and they don't want to wait till 4 o'clock in the afternoon to see how their portfolio is doing. They want to be able, when they go to lunch, they'll say, hey, we can pull it out and see what's the market doing today? What's my 401k doing? So instant gratification and the flexibility of trading during the day is also a very compelling reason for ETFs growth and popularity. Mutual funds still have a big place though. especially in retirement plans. And that's because most of us who have payroll deduction 401k contribution, and let's say you get paid twice a month and you invest that in 5 to 7 different mutual funds, whatever it might be, that's not a lot of money going into each fund. So it may be $27.35. With a mutual fund, you can invest exactly $27.35 because mutual funds trade in fractional shares. ETFs trade on an exchange, so you have to buy a full share. So there's been this real debate in the portfolio, in the plan sponsor, the fund sponsor, I should say, not confusing retirement plan, but a portfolio company, a mutual fund company. What type of fund do I want? Do I want a mutual fund or an ETF? And there's a debate back and forth which one's better. And a lot of mutual funds have converted to ETF. But when you do that, the mutual fund company is saying, well, we're going to give up retirement plan marketing as part of our strategy. So that's a really long way of saying that's why it's become popular is in having the ability to do both in the same fund is a compelling um, business plan for the mutual fund companies to be able to offer mutual fund and ETF in the same wrapper.
That's fantastic, Kip. I'm going to go back to one thing you mentioned too about just the ease of access and liquidity and being able to trade. We always hear about ETFs, and you mentioned it, cheaper costs than mutual funds. The tax benefits is a popular one, but very rarely do I hear, and it's a very good point that ETFs, you don't have to wait till the end of the day to find out what it's trading at. You can, and like you said, in younger generations, but even older generations, they want information now. They want access now. They don't want to wait, especially with their phones. So that's a very good point on why, and one that I never thought of in terms of why ETFs are so popular.
Yeah, we have Finance, Yahoo Finance, and a lot of people put their portfolio on their screen or where they can click on it and check it sometime during the day. And certainly, the portfolio managers, the wealth managers of the world, are probably looking at the markets all day long, just as part of their job, part of their responsibilities to their clients. So that ability without having to wait is important, or at least psychologically. There have been studies that said if you have the ability to change your retirement plan allocation every day, that actually reduces the number of changes because you say, well, I'll just do it tomorrow. But if it's only at the end of the month, there might be more changes. The same thing if you can only do it at the end of the day, you got a volatile economic period, you say, well, I might just go ahead and sell and see what happens if you can't watch it during the day and react.
And people want that instant, like you said, instant gratification. And trading is more popular than ever with Robinhood, all these other platforms. Trading is more, whether we like it or not. I'm not a big fan of day trading, but people do it, and ETFs allow
Well,
that.
with wealth, they're carrying their assets on a platform. For mutual funds, they may be charged a transaction fee, where for ETFs, you can trade it like a stock and it may just be a few pennies or no fee trades.
Mhm.
So we've had some experience with fund companies that had a lot more activity from the wealth manager community after they converted to an ETF or had an ETF available because the transaction fees were less for the wealth manager's clients, which is also a compelling issue.
Yeah, exactly. So about ETF share classes, DFA, Dimensional Fund Advisors, they were, I believe, the first asset manager that gained SEC approval. Now there's more, I think a few dozen,
40,
I think.
47 additional ones as of yesterday is my understanding.
Or up to date. Why did DFA want to offer the ETF share class to get this ball rolling? What was it? What's in it for them that they're like, let's do it?
I think some of the reasons that I stated earlier were I've heard the CEO and other representatives of Dimensional speak at conferences. They've got a very loyal following, as you know, in the wealth manager community. I know a trust company here in North Carolina that's their primary um, investment options for their trust clients. So, but it, 50% of the investment assets in this country are retirement plan assets, and 50% are taxable, approximately. So the ability to access both of those markets is important from a long-term strategy for the mutual fund company. It's expensive to start a mutual fund or an ETF. Um, we try to make it as economical as possible. That's our business plan while we're in business, but it's still it costs 60, $70,000 to organize one, and it costs 200,000 a year with no dollars in the mutual fund or ETF just to keep the regulatory filings, the legal audit, custody, and insurance, all the expenses that go into running it. So if you can put both a mutual fund and an ETF in the same fund, you're reducing that expense by 150, $170,000 off the just initially, and it's just much more economical to operate. As funds grow, they become more profitable to the mutual fund company or the ETF portfolio management company, while those expenses come down for the shareholders. So everybody really benefits.
Yeah. And then to just offer I'm assuming the same strategy, the same investment strategy philosophy in multiple wrappers. So then you go the one-stop shopping.
Right. It makes it so if you have a successful strategy and people wealth manager sees that in the retirement plan side, if it's now offered for their taxable clients, that's a bonus, and vice versa. Um, Most of the strategies, the mutual funds are older or more established, so it's the successful mutual funds that you want to make it more tax advantageous for the ultimate client, the shareholder, is what's driving most of it. But new funds that have been set up, which are predominantly ETFs, if you got a successful strategy, um, the, they're going to want to be able to access the retirement plan community with that. So you'll find some ETFs that are adding a mutual fund share class, going the other direction.
Okay, interesting. Yeah, just trying to grow that base, right? That asset under management base, and provide more options for the client. Like I said at the opening, that's a good thing. That can be a good thing. And speaking of that, so what does ETF share classes mean for financial advisors and their clients? Obviously, it gives them more options, more flexibility to go from a mutual fund to an ETF, and you did a great job explaining the benefits there. But is there something else? What does it really mean for them?
One of the biggest issues that is slowing down or making the implementation of the ETF um, share class a little bit slower is there's a big regulatory responsibility that's driven by FINRA and by the SEC on the broker dealer, on the brokers themselves to um, act in the best interest of the shareholders. Now, what does that mean? Um, is it purely based on the cost of the fund? How do you factor in the investment performance of and the relative cost of a bigger fund versus a smaller one by being able to have it? Where's the benefit there? How much can the tax issues be factored in? And it's the thing with the regulators, they don't really give you a absolute roadmap of what is acceptable or not. They'll just say, well, this seems like good advice. It's a good way to, and so when you have a newly created entity, a newly created product offering out there, it takes a while for the industry to kind of get best practices as to what the wealth manager needs to be thinking about in advising their clients which share class to get into. And that's a big issue for the broker dealers and for the wealth management platforms.
Yeah, that's a perfect point. Great segue, Kip. Perfect. Because when I started in the industry is primarily mutual funds and doing the share class calculator. What is it? A, C, B, what share class? Is there, is all regulatory driven, being a fiduciary, what's in the best interest of your client? Are there certain clients who are better suited for a mutual fund versus an ETF? And it goes along with what you just said, that regulatory, being a fiduciary, what is in the best interest of the client? Is there a tug of war there between mutual funds and ETF and what's most appropriate?
That's a wonderful question. The easiest answer to that is that the default for retirement plans, IRAs, and other um, qualified plans, qualified money, is a mutual fund will tend to be a better option just because of the ability to, it's more 401k platforms and IRA platforms. And if you're making a monthly contribution to a fund, it's much more efficient to do it in an open end mutual fund. On the other side, for a taxable um, retail or any taxable shareholder, whether it be retail or institutional, an ETF is, if you have any sort of capital gains strategy, it's going to tend to be better to have them in an ETF wrapper just because of the tax efficiency. Um, Again, it's not, you're not avoiding the tax, you're deferring it, but the time value of being able to reinvest pre-tax dollars versus after-tax dollars, wealth managers know that quite well. The compounding effect of leaving the money in the portfolio is compelling. So,
Great response there, Kip. They again, going aging myself, going back to when I started in the industry, it was always about mutual funds, active management versus passive management with the passive ETFs. That argument really doesn't withstand anymore with the active ETFs, right?
that's I would agree with that 100% because the lines have been blurred so much because active ETFs have been such a big proportion of the new ETFs in the last 3 years. It's basically replacing the actively managed mutual funds. Um, Before this share class, a lot of portfolio management firms, mutual fund companies were just saying the ETF's a better vehicle for us. Now they're going to say we this hybrid vehicle of ETF share class makes a lot of sense for business reasons for the mutual fund company itself.
The active versus passive debate was so 1990, so 2000. Uh,
Uh, yeah, there's active mutual funds and ETFs, and there's passive mutual funds and ETFs. So the lines are very blurred. You're exactly right.
yeah. So I think perfect spot to talk about, all right, financial advisors, they have this question now, mutual funds, ETF share classes, you start talking to their clients about the different options. What are some questions you think financial advisors need to be prepared to answer from their clients when it comes to ETF share classes? Are there some common questions that financial advisors need to know and the answers to?
To admit, it's been almost 40 years since I was on that side of the street, but um, I think in looking at a strategy, whether an ETF makes sense, one of the things to look at is what is the capital gains history of that fund. If that investment style tends to be have realized capital gains that are distributed to the shareholders, distributed to their clients, going to an ETF share class is probably going to almost by default make a lot of sense, assuming the the expense structures are in line. You said all other things being equal, sort of analysis on it. Um, if it's a if it's a strategy that's more income oriented, fixed income, or a much more of a buy and hold strategy where there's not a history of capital gains being realized and paid out, it's less of a difference. And there might be more of a need to focus on the expense ratio of the fund and expense ratio of the class because that's going to affect the return. Um, so those are some of the factors you would think in the tax implications and the anything that's going to affect the net return of the shareholder, of course, would be the factors that you look at. The after tax, pre-tax, after-tax comparison, and the expenses of the portfolio return less the expense ratio of the fund would be important.
We've talked a lot about in that response, Kip. Didn't sound like you were. It sounded like you were in the on that side of the street just yesterday. Perfect. Perfect. We talked about benefits, obviously, ETFs, benefits of mutual funds. But talk about that exchange from, doing a mutual fund to ETF exchange. What are the benefits there and also drawbacks? Like, there's no free lunch in this industry, so we got to talk about the risks or drawbacks too to conducting a mutual fund to ETF exchange.
I'm not sure that there's a risk to the shareholder. There shouldn't be because it's a mathematical calculation and it, but there's an operational issue that's kind of in the back office is hidden, but it's a real one, and it's also a limiting factor for some of the platforms adopting ETF share classes or not. And the comparison I like to give, and that I've spoken at a few industry conferences this year on this subject because it has been, as you said when we just opened this discussion, it's been a very hot topic for the last 12 months or so. Um, a comparison I like to give is the movie Apollo 13, which is a great movie. Ron Howard directed it, and Tom Hanks, of course. And they get stuck in space, and they didn't know they were going to have to survive in space that long, and carbon dioxide starts becoming a problem. They decide that they need to use both the lunar module and the command module to scrub the carbon dioxide. Well, they were made by two different manufacturers. One of them had square hoses, one of them had round hoses, one of them's 5/8 inches, one's half inch, or whatever but they weren't designed to be connected, but they needed to connect them. It's the same thing. It's really very similar to that in the mutual fund and ETF industry. They were built at two different times for two different settlement processes used by really different parts of the investment world, and they weren't designed to communicate with one another. And now, with having a fund that has both mutual fund and ETF, you're trying to figure out a way to communicate between the two. So you got fractional shares in the mutual fund and whole shares on the exchange in the ETF. If you exchange between the two of them, there's going to be money left over or additional money that needs to be paid in to get to a full share, one of the two. So that's a calculation that needs to be done. And then the settlement of ETFs can occur all day long during the business day, the trading day, and mutual funds trade only at 4 o'clock as of the 4 o'clock price and overnight. So Vanguard has been offering these funds for years. They've been doing it manually for the last 7 or 10 years, however long they've been had a monopoly on this side of share class. Most of the platforms, the Schwab's, Fidelity's, LPL, Raymond James, platforms that your viewing audience uses to carry their client accounts, and others, of course, the wirehouse broker dealer, the broker dealers, their back offices are saying, "Wait a minute, how are we going to deal with this?" And so it is a bit of a technological issue. We're one of the few transfer agents that is processing both mutual funds and ETFs, and we're small enough so that we do it in the same office. State Street and Boney Mellon and U.S. Bank and Brown Brothers and Citi and others do it, but it might be in different offices or different floors of the same building or different cities even. We're small enough it's done by the same group of people. So with that, we were able to say, okay, what do you need to do to communicate between the two? And we built some software. We're um, actively willing and are talking to a number of the big mutual fund transfer agents about providing that to them because the market needs it, and we know that um, their market share is so large that they, it's, so anyway, there's some technological challenges, but they can be solved.
Yeah. Is that when you were explaining that, first thing I thought of is how in the world do you do this at scale? It sounds like it can be a very labor intensive product, doing the conversions, and especially maybe one household has a lot of different ETFs that they're trying to exchange or do that conversion. Technology, is that really what you have to rely on now to do it, make it scalable?
Oh yeah. Absolutely. Trying to do it manual would just be a mess and ripe for errors. We've tested the technology that we built, and we tested it for 1 million transactions, so it can be done. Yeah, it's processing power at that point. But it can be done, but because ETFs need to be on a broker dealer platform, um, and a lot of mutual funds you can buy directly, of course. You can just write a check and send it to an address on the bottom of a form for a mutual fund. Those shareholders that want to have ETF class of shares, it will need to be in a brokerage account, which is where most wealth managers hold their client accounts anyway, because of the that was a technological thing as well. That's how Schwab and Fidelity and the others early in 20 years ago got such large market shares, because they were able to pull these different transactions from different platforms and put it on the same report. It's very much the same way here, just a little bit different problem.
I wonder how many people you just opened up their eyes thinking that's how you buy mutual funds is sending in a check, but not just electronically.
Oh yeah, we've been in business for 37 years, and we used to have a courier come by the office every afternoon with one of those bags that had a lock on it. You've seen them from the bank, and they would take it to the bank, and they'd process something, and then they took those same bags of checks out to the airport, and um, put them on airplanes and took them to Charlotte in North Carolina. Took them to Charlotte so they could be processed at the Federal Reserve overnight. The hard checks. So there was a whole industry of old airplanes and young pilots flying these checks all over the state to get them to the centralized Federal Reserve clearing operations. Is a different world today.
The cost of doing that, right? The cost, and now it's a lot cheaper. You eliminate that cost and a click of a keyboard, and you got it now. Talk more about financial advisors when they're having these conversations with their clients. What are some of the most important things financial advisors should address when having that mutual fund to ETF exchange conversation with their clients? Are there some certain things you have some tips about those conversations that can help them?
I think having been involved in those conversations where somebody asks you a question, they expect you to have some industry knowledge. I would encourage the wealth managers just to do a little bit of reading and understand the tax benefit of ETF, why it is advantageous, because I'm sure the shareholders will ask that. Well, I've heard that ETFs are tax efficient. What does that mean? And so, and I'm sure that the platforms and the firms that wealth managers clear through have good literature on that subject. And there's plenty of it available on the internet, of course. So being well versed to answer those questions, predicting what the question will be, is always important. So that's certainly going to be one. And if somebody was asked why their mutual fund started offering an ETF share class, um, we've talked about why that would be, and then they might get asked that question. Um, so I think the wealth managers are some of the best educators on financial literacy in the country. They're the front lines of defense. So um, they're probably used to staying up to speed on new issues that come along.
Yeah, you're exactly right. And I'm a firm believer. I think they should do more financial education, investment education in schools when it comes to that financial advisor, and goes back to all the different products that they need to be educated on. They've got to have a large library of resources to help answer a lot of those questions, or ask the right people to help with the conversation.
Yeah, yeah. There's nothing wrong with saying I'm not sure, but I know who to ask.
Yeah. Yeah, exactly. I have to do that a lot, Kip. I do that a lot. So you talked a little bit about it, the cost or the economics for the asset manager who's offering the ETF for the mutual fund. I guess I didn't realize the cost, it was 200 some thousand dollars just to keep keep the do the regulatory back office stuff for an ETF or a mutual fund. What's the cost to the end investor conducting an ETF exchange?
There shouldn't be any, is the short answer to that, because those costs are at the fund level, and so they will be baked into the expense ratio of the fund itself. And the accrual for expenses is going to need to be relatively in line between the share classes. The difference in the expense ratio for different share classes is supposed to be um, closely aligned with the different ways of distribution, which can be accrual or 12b-1, or how the marketing expenses are paid and how distributors are paid, wholesalers, and so forth. Because in theory, and actually, the larger a fund gets, the better it is for the shareholders, because the expense ratio goes down. Um, so I don't know if that answers your question or not, but yeah, the expenses are yeah, at the fund level.
Nope, that's perfect. And lastly, again, for the financial advisors out there, the wealth managers listen to you. They're like, okay, perfect. We're going to do, the mutual fund to ETF conversion. Great for this set of clients. Let's do it. What's the process? Is it click of a button, filling out a form? What's the process of conducting that conversion?
Sure, that's going to be different. So that has not been standardized yet in the industry. That's something that is out there. DTC, the NSCC clearing a fund serve, which is how mutual funds clear, does not have the capability of doing that. So different broker dealers, the platforms are probably going to have different processes, um, depending on whether they license technology such as the technology that we have built, the ETF Lighthouse, or they wait for DTC to build a system to communicate this type of transfer, or whether it's done with another SFTP or um, um, online. What's the other? I can't think of the other type of electronic transmittal, but API, right? Yeah. So there are going to be electronic ways to do it, but those are still under construction, frankly. And the broker dealers, the platforms that your viewing audience is carrying their client accounts on, is frankly still trying to figure out how they're going to do it. That's why you haven't been seeing a lot of them that's already gone to market yet. They're still thinking about it.
Awesome, Kip. Fantastic conversation. A lot of fun. If the Badgers and the Blue Devils play maybe this spring March Madness, well, come on, and maybe we'll have to have the way the Badgers are playing, though. I'm not sure it'll be nearly as good as that national championship game. It was an honor. Thank you for sharing such great insight. Where can our audience get more information about Nottingham Shareholder Services?
Our website is nottinghamco.com, and you can also reach it with NC Funds, ncfunds.com. Our primary clients, of course, are the fund companies themselves, but if we can help with any of this information, be delighted to try. And thanks for inviting me. I enjoyed it. It was a lot of fun.
Fantastic. Awesome, Kip. Thank you. I'll include those links in the show notes for all of our listeners. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.